Hey everybody, welcome back to another edition of 5 Question Friday. This is where I do my best to answer questions you all have sent in. If you'd like to submit a question, you can subscribe to the free newsletter that goes out every Sunday morning. You'll find a link to the newsletter below this video. And then when you get the newsletter, just hit reply, send me an email. I read them all. I reply to many, but you can submit your questions to perhaps be on a future 5 Question Friday video. So with that, let's dive in. So here are the 5 questions we're going to look at today. Are growth stocks or stock funds the best for a Roth IRA? When should you pay taxes on withdrawals from different retirement accounts? How should that work? A daughter actually wrote in for her mother who's 76 and really scared to invest in the stock market. So the question the daughter had was, how should my mom invest her money? We'll look at that. And then another person wrote in and said, hey, what do you think is the ideal sort of set it and forget it portfolio for someone in retirement? And this is what they wondered about. Is this the one? We'll look at it as I mess up my list here. I don't know if I can fix it. There we go. And then the 5th question, so the viewer is going to pull money out of different investment and retirement accounts to build up their emergency fund, and how should they think about that? So, in doing that. So those are the 5 questions we're going to try to tackle today. We'll get started here with number 1. And it was from Mark. He said, thank you for all you do with your channel. Appreciate it, Mark. Kind of skimming here. He says they have twin children. They're 25. They're maxing out at their employer plans for the company match, and they're also maxing out their Roth IRA contribution. So, Mark, I don't know what you did, but congrats, it's working. And then here's his question: why wouldn't people in their situation, meaning they're very young, they got a long time to go before retirement, invest exclusively in relatively aggressive growth stock funds? He mentions VUG as an example. So it's a great question. Now, we've talked about growth versus value before, but we can sort of categorize stocks as either growth or value, or maybe kind of in the middle of those two categories. So a growth stock would be a company that's growing its revenue and hopefully its profit a lot They're faster than average, faster than your typical public company. Think an NVIDIA. You know, they're just making money hand over fist. Their revenues, I think, last year were up over 100% from the year before. I mean, just crazy growth because of AI. It's a growth company. Now, if we compare that to a value company, we can think of Berkshire Hathaway. Berkshire, great company, run by Warren Buffett. It's not growing its revenue by 100%. I wish it were, but it's not. And so you would look at that and you say, okay, well, Berkshire's a value company. NVIDIA is a growth company. Isn't it sort of obvious that growth is better? Well, no, because growth companies are more expensive than value companies. And it's important to understand what I mean there. When I say they're more expensive, I don't mean that the cost of an individual share is more expensive. The cost of a single A share of Berkshire Hathaway is over $700,000. Not kidding. The cost of a single NVIDIA share is about $142, I think. That doesn't tell us anything about whether it's a growth or value company. What we need to look at is its price relative to different aspects of its financial position, like how much it's making per share, or its sales per share, or maybe its book value, net worth per share. A very common way to look at it is price compared to earnings, the PE ratio. So we're not just looking at price, we're comparing the price per share to the earnings per share. So for example, right now, again, NVIDIA is trading at about $142 per share. And in its last 12 months for fiscal 25, which for them ended earlier this year, I think they made about $3 a share. So, you know, you buy one share at $142, and what you get for that is effectively $3 per share in earnings. That translates into a PE well over 40. In the case of Berkshire, its PE is around 12. So relative to earnings, Berkshire is a lot cheaper than NVIDIA. And so that kind of gets into the tension here. Do we invest in a company like NVIDIA that's expensive relative to its earnings, but it's growing its revenue really fast? Or do we invest in something like Berkshire that's not growing nearly as fast, but it's a lot cheaper relative to the money that it's making its investors? So which one is better? The short answer is sometimes value stocks do better, sometimes growth stocks do better. Let me show you what I mean. Here is This is a VUG. This is the ETF from Vanguard that Mark mentioned. I just show it to you so you can see it. You can see it's definitely a growth fund. You can see some of its holdings, Apple, Microsoft, NVIDIA, a lot of tech companies, right? Because they're the ones really growing their revenue very quickly. And we can look at this. We can back test this. Let's see. Here we go. I did a test comparing VUG to VTI. VTI is just a Vanguard total U.S. stock fund. So it's going to include both growth and value. Now, because of limits in data for this tool, this is Portfolio Visualizer, I only go back to 2016. But we can see that, sure enough, VUG outperformed. VTI turned $10,000 into $32,000. VUG turned $10,000 into $42,000 over the past 10 years. So it performed much better. When we look at it year by year, we can see they were kind of neck and neck for a while. And the outperformance didn't begin until around 2019 into 2020 and COVID and then after that. And actually, by 23, they'd grown almost identical, they, close together, but then, VUG took off again, and now there's a pretty decent spread. But this is only 10 years. If we go back, we look at this, and we don't put those tickers in, but instead we just look at asset classes. So I compare total U.S. market to U.S. large cap growth and U.S. large cap value. But this goes all the way back to 1972. We can see, and I know that the text is a little small. Let me see if I can make it a little bigger, maybe a little bit. The one that did the best was value. It turned 10,000 into 2.8 million. Now, again, it's a big number, but this is over 50 years of compounding. In contrast, growth turned it into 2.4. Maybe not a massive difference over a 50-year period, but still value outperformed. Now, we can actually sharpen this a bit. Let's come back to our portfolio and edit it. And what I want to do is, instead of going to 2025, let's go back to 2010. And analyze the portfolio. Now, the total numbers will go down a lot because I've just cut out 15 years of compounding. But you'll see the difference. Value ended up at 618,000, growth just 322. And in fact, U.S. stocks overall outperformed growth, 395. I underscore this, I show you this to underscore that sometimes, and for long periods of time, value or growth can outperform. Value outperformed for a long time. Now growth is outperforming for a long time. And that raises the question ultimately that Mark's asking, okay, well, now what? The first thing to understand is there's no magic about a growth stock. There's nothing special about it. It kind of drives me crazy when Dave Ramsey says, you should invest in a growth stock. I'm not sure he knows what it means. Maybe he does. I don't know. I shouldn't pick on Dave. But there's nothing magical about growth. Growth is not better than value. All right. It's just different. And sometimes growth outperforms, sometimes value outperforms. So what should we do? Well, there's a couple of approaches. One approach would be to say, I don't know which one's going to outperform, so I'm just going to put everything in a total U.S. stock market, which is what Mark's kids are doing now, I understand, but in VTI. It's just sort of a total U.S. stock market fund. It doesn't favor growth or value. That's one approach. You could go to an extreme approach and say, no, Rob, I really think pick growth or value is going to outperform, so I'm going to put all my eggs in that basket. I'm going to buy VUG, VUG, or I'm going to get the Vanguard Value Fund because they have a value fund, one or the other, and I'm willing to take that risk. Okay, that's to me a pretty extreme risk. A middle of the road approach would be to say, well, I'll just pick a number, 75% in VTI, but I'm willing to risk 25%, and I'm going to put it in growth or value. You really have to pick. And to some extent, I did that for a long time, not that much, but I had 10% in large cap value and 10% in small cap value. This was more than a decade ago. At this point in my life, I'm just, for the most part, happy to just have a portfolio that doesn't try to pick value versus growth. But that choice is really up to you. The biggest thing and the most important thing in my view is to pick something that you can stick with. And that's where I could not stick with just value or just growth, because you would have to be willing to go 15, 20, 25 years underperforming the total market, because that's how long these cycles can last. And so just keep that in mind. So no, you don't hear the word growth to describe a stock or an ETF or a mutual fund and think, oh, that's going to grow more than a value fund. That's just not how it works. So there you go, Mark. That's my answer to the first question. All right, let's look at the next one. When to pay taxes on a retirement account. Still 5 to 6 years away from retirement, I've been wondering about taxes when withdrawing from a portfolio. Is there a recommended approach? Do I have taxes withheld when I make a withdrawal? Do I pay them quarterly? Do I pull out my expenses for the year plus the amount of tax I think I owe? So great question. Ultimately, I would work with your tax preparer or a tax advisor if you have one. But here's how I think about it. If I'm going to make certain withdrawals, for example, I'm not that age yet, but for required minimum distribution, you can have your broker withhold taxes for you. And in fact, they're required to hold a certain amount already. In fact, I'll show you this. I'll leave a link to this Schwab publication that talks about some of this. But you can have them withhold taxes for you. So that's pretty convenient, right? And same thing with Social Security. So there could be some distributions that you get where they can withhold taxes for you, and it's just easier to do it that way, right? But there could be other cases where that's not true. Like you just go into a taxable account and you sell some shares at a gain and you pull it out, or you go into your traditional IRA and just pull money out on your own. It's not part of an RMD. And so what should you do there? And my view is most of the time, you should be paying quarterly estimated taxes to avoid any penalties that you might get at the end of the year if you don't, and just to avoid any surprises. And I have our tax preparer calculate what our estimated taxes should be every year. In our case, she's looking at business income, dividend and interest income. If we plan to do any Roth conversions, that's going to trigger taxes. So she'll factor that in, and she calculates how much we should pay every quarter, both state and federal. In fact, I just paid the second quarter taxes yesterday. So to me, that's the best way to go about it. There have been times, there is a safe harbor amount based on your prior year's taxes, and your accountant can help you calculate that, where as long as you've paid that much, you're not going to get penalized. And I've relied on that safe harbor. In fact, I did that for tax year 2024, and I didn't pay as much as I needed to in estimated taxes, and just saved the money in a savings account, or in my case, we used a short-term treasury ETF so that I could earn the interest. And so that is another option to think about. You just have to be prepared, because when tax time comes, you want to first make sure you've met the safe harbor number, and then you got to be prepared potentially to pay, whatever the amount is. Could be a big number, maybe not, but you got to be prepared for that. So that is another option to think about and talk with your tax preparer. Okay. Third question. How to invest when you're 76 and scared of the market. My mom is 76, plans to live on her Social Security. So that's important. She doesn't need her investments. She can live on her Social Security, but she has about $185,000 from the sale of a house. So this is going to be in a taxable account. And she could use it for living as well, and maybe leave some for her children. She's not fond of the stock market. So what can she do? Well, there are a couple of options. And again, I'm not a financial advisor. This is just general thoughts, questions I would be asking. But you can obviously seek financial help from a financial advisor. But you could, of course, put it in, I'll say, a safe investment like treasury bills. Maybe a money market fund. I put that in air quotes, safe, because those are generally viewed as safe in the sense that you shouldn't lose money, but they may not be safe in that they could end up giving you returns that are lower than inflation. And so you could be losing purchasing power over time, but maybe you sleep better at night, right? So that would be one option. Another option is build a tips ladder. Now, yes, you might need to get a little help from your broker, depending where you're keeping this money. It's not that complicated, but it might be something that your mom's not comfortable doing. But the nice thing about a tips ladder is it's as secure as you'll get. These are U.S. issued government bonds, but they do adjust for inflation. So you kind of know what you're going to get on an after inflation basis. She's 76, so you'd have to decide how long you want this tips ladder to last. You maybe set it up for 20 years, depending on how long, for planning purposes, how long you think the retirement will be. And you could do a tips ladder. But again, a little more complicated, but it's an option. The other thing to think about, and I'll give you an example of this, is there are funds that invest in, you put money in one fund, and it divides your money up into different investments, stocks and bonds. This is a Vanguard Life Strategy Fund. This is the actual page. They have 4 of them with different stock bond allocations. The most conservative is this one. So it does have some stocks. This would be something you want to explain to your mom. $20 out of every $100 you put in here would be in stocks. $80 out of every $100 would be in a bond funds, but fairly conservative. I would say very conservative. I actually looked at the second one, which is 40% stocks, 60% bonds. I put that in Morningstar. Here it is. And I went to the performance tab. And you can see year by year how it's done, going back to, let's see, how far back does this go? 2015, it's basically flat. It lost 0.17. Then it was up 6%, up 11%, down 3%, up 15 or 16%. Its worst year was 2022. It lost 15%. But this is the kind of thing you could talk to your mom about to show her this. It's very simple. It's just one fund. And by and large, fairly safe. Again, it's not without risk. 2022 was an exceptional year because both stocks and bonds were down. That doesn't happen very often like it did that year, but it can happen, right? So it's something to think about. I suppose an even more conservative strategy would be the 2080 fund. This one's probably not going to have done a whole lot better in 22 because, again, bonds were down, but we can look at it real quick. Go to performance. Yeah, it was still down 14% in 22. But again, overall, it's usually if it's down just a small amount, and other years it's up, and in some years quite a lot, 12% in 19, 9.5% in 23. So these would be options that are both simple and relatively low risk, but certainly not zero risk. So that's something to keep in mind. So again, those are just ideas to think about. They're not specific recommendations for your situation. There'd be too many other factors to consider. But it's something to think about, and you could perhaps work with someone to help come up with a final solution. Part of the question would be, how much of that money is she actually going to spend each year? Because you're going to want to generate cash from it, and it might affect how you decide to invest it. Or is she not really going to spend most of that and just rely on Social Security? Again, those would be questions to think through and to answer. But those are at least some ideas to consider. Okay. Fourth question. Hi, Rob. Appreciate your commentary. Thank you. I have a question dealing with bonds in the other part of retirement portfolio. This person's 72 years old. Been watching. Apparently, there are a slew of videos that say, forget bond funds. Instead, invest in VU, which is S&P 500, and SCHD, which is a dividend ETF that I own. Videos that are compelling. Maybe you are familiar with ditching bonds for dividend ETFs. Let me just stop there. That's not the ultimate question we're going to tackle, but I am familiar with YouTubers saying that, and I disagree with it. SCHD, I own shares of it. I think it's a reasonable fund. It is not a substitute for bonds. It's a stock fund. It's not a bond fund. Its risk is much greater than a investment quality or U.S. government bond fund. You certainly can backtest this portfolio as compared to one that has bonds in it instead, and this portfolio will outperform over the long term. Why? Because it's a 100% stock portfolio. You're taking on far more risk. You're comparing apples to oranges. So I think this is all nonsense. Okay, that's not the ultimate question. So Rob, with that long-winded intro, my question is simply, if you could only recommend one smart set it and forget it retirement portfolio for a low-risk tolerant 72-year-old, would it be this? 48% in an S&P 500, 12% in VXUS, and 40% in BND. Well, number one, I think that's a perfectly reasonable 60-40 portfolio, right? And when I say 60, I'm adding the two stock funds together. That gets us 60. And then the 40 would be the bonds. I think that's a perfectly reasonable portfolio for retirement, but I would ask some questions. I probably wouldn't. This could be. I don't have one set it and forget it retirement portfolio. I could probably come up with hundreds of them. Would this be one of them? Yeah, it would. I would ask some questions. For me, I'd say question one, maybe I should have a little more in VXUS than 12%. Because I think I kind of like a little bit more international exposure. That'd be one question or thought. Two, it's not a huge difference to switch VU to VTI, but I personally am more comfortable with a total U.S. stock market fund than I am S&P 500. That's my preference. You look at the returns and they're very close. So it's probably more of just a sort of theoretical preference than actual practical. It's going to make some big difference in the portfolio difference. And then the last thing I'll mention with this fund is that B&D doesn't have any tips, and I really like exposure to Treasury inflation protected securities. Whether it's in a fund or a tips ladder, I think both can be reasonable, but I certainly prefer some amount in tips. And so that would be my preference. So is this one reasonable approach? I think it is, but some caveats, and those are the three that come to mind. At the end of the day, you do have to figure out the asset allocation. That's probably the most important thing. And again, I think 60-40 is one of many reasonable choices. A lot of that's going to depend on your own personal risk tolerance. I don't know that I would call that low risk. I would call it maybe moderate risk, maybe. So if you're truly low risk and scared of the stock market, I'm not sure 60-40. I'm not sure I would categorize that as low risk. That's my opinion. But keep in mind, there's no real official definition of what low risk is. Okay, great question. The last one. Now, this was a longer email. I didn't include it here, but we'll look at the question. How should you draw cash from an investment account for an emergency fund? And so the viewer, I believe her name was Robin, but I may be misremembering. But she has a lot of different accounts: traditional retirement, Roth, taxable account with stocks in it, really low cost basis. So she sells some of those stocks, going to trigger some taxes. And the question, there were kind of two questions baked in. One was pulling money out that you're going to spend that year, okay? But the second one was pulling out money to stick it in an emergency fund. And one of the things she pointed out was that in her traditional IRA, which she'll be able to tap penalty-free later, I think it's later this year, she has a lot of cash sitting there. So the idea was maybe when she turns 59 and a half later this year, should she go ahead and pull that $70,000 out to put it in like a high yield savings account or some other emergency fund. So two different questions. They're both really important. When it comes to spending money in retirement, my approach, a couple of things to think about. First, I want to spend any money that's going to be taxed whether I spend it or not. So that would include interest and dividends from a taxable account. If I get interest or dividends from my investments, they're going to be taxable income whether I spend them, stick them in a savings account, reinvest them, they're going to get taxed. And so if I need money to spend, I want to pull from that first. Same thing with required minimum distributions. If you're at that age, it's going to get taxed, so I'm just going to spend it first. If I need more money to spend beyond that and beyond any guaranteed income you get like Social Security and maybe a pension, then I'm thinking about my taxes. And I'm thinking about my taxes not just in that year, but down the road as well. But you can also think about it though, just year at a time. Am I close to a higher tax bracket? Or am I close to a IRMA cliff number where I'm going to pay more for Medicare? So I'm looking at those factors to decide, do I want to take it out of a Roth where there's no taxes? Am I okay taking it out of a traditional where I get hit with ordinary income taxes? Maybe I take it out of a taxable account where not every dollar is taxable, and presumably what will be let's assume long-term capital gains. But that's a tax question, and you have to look at it both year by year as well as the bigger picture, particularly as you look down the road to when RMDs kick in, because part of the equation here could be, should you be doing any Roth conversions right now? And of course, that's going to trigger taxes. So it's all sort of folded into one question that you need to think through, and maybe either use a tool like Boldin, which is what I use, or you could try to do it by hand, but it'd be probably pretty difficult to project all of that out all those years. Or you could just talk to a tax planner, a financial planner, to help you with the analysis. But the second question, should you pull money out that's going to get taxed to keep it in an emergency fund? In my view, the answer is no. I'm not going to pull money out of a traditional IRA, for example, just to stick it in some other investment, whether it's a savings account, treasury bills, a money market fund, for a rainy day, because I don't want to trigger the taxes unnecessarily. If I want to hold cash, that's fine. I can keep the cash in the traditional IRA in a money market fund or or a T-bill fund. And if I do need it, if the emergency does hit, I can take it out then, but I have to. Yeah, I'll pay the taxes, but I have an emergency. So I don't see any reason to trigger the taxes now, because it might be 5 years before I have an emergency. Now, you may say, well, Rob, couldn't there be some circumstances where it might make sense to pay the taxes now? Maybe I'm in a lower bracket. I want to trigger the taxes. And maybe in 5 years, I'll be in a higher tax bracket. That's true. That could be the case. And it may suggest not that you just pull it out and stick it in a savings account. It may suggest you do Roth conversion. Now, when you do a Roth conversion, you normally have to wait 5 years for each conversion before you can take the money out penalty-free. That's the 5-year rule. But remember, if you're already over 59 and a half, the 5-year waiting period for Roth conversions no longer applies. There's a different 5-year rule when you open an IRA. That always applies. But the 5-year rule on Roth conversions stops becoming applicable once you reach 59 and a half. And I know that's not the question, but I'm going to talk about it briefly. I got an email about it this week. Keep in mind why they have that particular 5-year rule. Why do they have the 5-year rule on Roth conversions? Because what they don't want you to do, let's say you're 55, and you think, I want to pull my money out of a traditional IRA. I got to pay taxes. Can't avoid that. But I don't want to pay that pesky 10% penalty. So you know what? I'm clever. I'm going to convert it to a Roth. I'll pay the taxes. But I got to do that anyway. And then when it's in the Roth, I've heard I can take out money tax and penalty free. I'll just pull it out then. And so what the IRS says is, yeah, we've kind of caught wind of that. You think you're clever, but all you're really doing is trying to sidestep the 10% penalty rule for traditional IRAs. And so to discourage you from doing that, when you move money over through a Roth conversion to a Roth, we're going to add 5 years. You got to wait 5 years before you can get around that 10% penalty. But if you're already 59 and a half, you're not subject to the 10% penalty from a traditional IRA. You're not trying to get around anything. You don't have a 10% penalty anymore. And so, yeah, if you're 61 and you're doing a Roth conversion, that 5-year rule on the conversion doesn't apply. The 5-year rule on how long you have to have opened up a Roth IRA, that 5-year rule, you could be 137 and it still applies. If Warren Buffett goes out today and opens up his very first Roth IRA, he's got to wait 5 years. Now, the consequences for not waiting depend on the circumstances. They're different. I've done a video on those rules, and I'll link to it below this video if you're interested. So there you go. Appreciate your questions as always. I do my best to answer them, but I'm not perfect. So, if you've got something to add, maybe I've missed something, leave them in the comments below. And if you have questions, you can leave them there as well. I'll do my best to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.